Armed conflicts are driven by megalomania and hence impossible to analyze. Aside from the human misery, financial markets' first reaction is higher oil prices. And Brent did trade up almost 10% at one stage and is up between 4 to 5% at the time of this recording. This is on top of a 20% rally year to date. Disruptions aside, do note geopolitical spikes rarely sustain. What sustains, however, are underlying demand and supply forces. So, despite missiles flying over the Middle East skies, we stay focused on the macro and what's moving markets. Over the last 4 months, the S&P is barely unchanged, but lift the hood and there is a violent rotation underway. Tech has underperformed by over 900 basis points and discretionary and comm services are barely keeping pace. Growth has been a passenger, not a driver. So, what's performed? Industrials, materials, energy, and staples. And they've handsomely led the charge. Another rotation is in the macro. Even as labor data moderately softens, inflation is back in focus with the latest PPI reading underlining the pressures. And then there is the rotation into havens, US Treasuries, gold, and silver. And despite higher PPI, yields below 4% reflect a flight to safety rather than the macros. And a sharp bounce off recent lows in precious metals is yet another sign of rotation into safety. Secular trends drove markets for 3 years. This year, wars will wane, rotation remains. This is Sunil Garg from Keen Eye and Lighthouse Canton.